movements across pockets. So pharma has done extremely well, maybe buoyed by Divi's news or otherwise, but from the Aurobindos to the Ciplas to the Sun Pharmas and Divi's, of course. I mean, it's a top gainer on the Nifty NSE 500. So maybe an Infibeam has just kind of overtaken it. But I think those stocks have done very well. On the flip side, Tech Mahindra is not having the best of days. Down about 4.5%. You could argue that the results were probably okay, but maybe there's a bit of a run up and there's a bit of a scare that people have about whether they will be able to maintain the kind of margins that they've clocked in this quarter or no. Seems unlikely to a lot of people. So therefore, there's a bit of a fall there in Tech Mahindra. 4.5% actually, not a bit of a fall. But two or three things stood out for me individually. One is that the PSU stocks continued to gain today. Selectively, I might add, but Dredging Corp, Hindustan Copper, MMTC, both of them have done well. And then two things. Hexaware, and just shows the buoyancy that people have in mid-cap IT. The numbers were okay, margins were great, revenue growth 0.4%, so nothing too dramatic. But the management, when they spoke to us, told us about how they believe, this is one of the few managements which said that they believe they will clock in at least the upper end of their guidance. They follow a calendar year, so next quarter is the last quarter for them. Right. But they log in at least the upper end of the guidance. Most of the other companies have said, if we manage guidance, we'll do it at the lower end of the guidance. So maybe that commentary helping the stock up about 12%, I believe, Hexaware at the current point of time. So really strong move for that one, and goes in with this whole theory that we've been talking about. The mid-cap IT somehow has done very well. And then guys, strong stocks continue to do well. Rain Industries has gained. I just used the terminal to figure out what are the latest trade insights for Rain Industries. Has gained for 7 consecutive weeks, double-digit gains in 3 out of 7. And Motilal Oswal, after this run-up has happened, has come out with a buy recommendation with a target of 632 or thereabouts. So certain strong stocks continue to gain, even in today's session.
All right, Neeraj, thanks so much for that. That's the domestic markets. Globally, no disruption so far on the global market front. The US Federal Reserve did exactly what it was expected to do, kept interest rates unchanged at the 1 to 1.25 band. As expected, rate hike most likely to follow in December. No change in that, unless there are some unforeseen weaknesses that crop up in the economic environment. The FOMC made minimal changes in the economic outlook as well. The committee expects the US economy to evolve in a way that warrants gradual rate hikes, said that the economic activity is rising at a solid rate. Labor market also continues to strengthen, and that household spending is expanding at a moderate rate. Inflation, on the other hand, remains below the 2% target, but that hasn't prevented the Federal Reserve from raising interest rates and unwinding its balance sheet.
But that was not what grabbed the headlines. What grabbed the headlines were reports that President Donald Trump plans to nominate Governor Jerome Powell as to the top job at the U.S. Central Bank. 3 people familiar with the decision told Bloomberg that President Trump is likely to make that announcement tonight. Bloomberg's Kathleen Hayes has this report.
Another in a long line of reports, I think, that give us solid information on what Donald Trump, where he was heading, and now what he apparently has decided. No surprise, because he's been telling Bloomberg and others that he's been leaning towards Jay Powell. At least his staff has been telling us this. Yellen's term, Janet Yellen, the chair for nearly 4 years now. Her term is up February 3rd. And I think the question now everyone's asking, okay, so who is Jay Powell? Does he have the right stuff? So let's look and remind ourselves again just who he is and what he has done. Because he's studied law. He's not an economist, but he went right into investment banking once he got his law degree at Princeton, Georgetown Law. Dillon Reed, Bankers Trust, Carlyle Group, very esteemed names in this industry, and served in government after he got himself established in the financial industry, Undersecretary for Domestic Finance under George H.W. Bush, among other positions, a Fed governor since 2012. So certainly this is a man with a long history. Now, the question is, what will he mean for monetary policy? He is seen, as many say, Janet Yellen 2.0, that he'll continue her monetary policy path. So let's just look at some of the aspects that he has said in his speeches. Fed's close to its mandates. Certainly on unemployment, on inflation, they're far away, though, Mr. Powell. But this is exactly the kind of thing Janet Yellen says. Policy is currently very accommodative. It's appropriate to gradually normalize rates, which means raise them slowly. And below target inflation means you don't have to go quickly. You can have a lot of patience. So how is this sitting with people? Ethan Harris is the chief U.S. economist over at Bank of America Merrill Lynch. He gives a big thumbs up to Jay Powell. He spoke to our Matt Boesler from our Fed team here in New York, and he said he thinks that Jay Powell will be a very good choice, that he has exhibited sound judgment, will continue to do that as Fed chair. Chris Rupke over at Bank of Tokyo Mitsubishi, I think, has some doubts that a lot of people are going to express as we go through this process now of Senate confirmation and more. He says, look, the Fed chair since the 1980s has become like the nation's chief economist. And the question is now, could a non-economist, when it gets down to it, go before Congress? Let's say there's a little opposition. Can they go up and defend policy? And how would Powell perform in a crisis? This is a question as well. And again, Senate confirmation will come soon. I think Powell's expected to get through it. He's already been confirmed twice by the Senate Banking Committee because he's had to do that twice to be a Fed board governor. But there's some big questions here still.
All right, that's the global macro and markets picture. Let's get into corporate news. Divi's Laboratories jumped more than 15% after the U.S. drug regulator lifted an import alert on its facility in Visakhapatnam. Darshan Mehta standing by with the implications of that. Darshan.
Ira, what this means is that Divi's lab is now free to export anything to the US markets. What had happened last year was the US FDA came and inspected the facility somewhere in November, on the first week of December. They gave them a Form 483 with certain observation. That later got converted into an import alert because they believed that there were data integrity issues there. Later, post that, the warning letter came out in which they gave out the details why they had given that import alert. A few months ago, what had happened, and then there was this another import alert on a different scale in which Divi's had it said that Divi's management did not restricted access for the US FDA to certain parts of the plant. So that was resolved in the first week of July. Post that, what this now means is the fact that Divi's was given some leeway to export some of the drugs. Now with this import alert and warning letter being lifted, it means the fact that Divi's can export everything to the US, including the drugs that were not allowed. As far as the contribution is concerned, US currently contributes almost 33% of the total sales, and on this 33%, 20% is coming in from Unit 2. Now what this means is that the entire downside risk that analysts were building into the estimates can be eliminated, and sentimentally this is a big overhang that was there, and that gets removed for Divi's lab now.
Darshan, thank you for that. That stock is about 15.5% in trade today. Auto sales, meanwhile, have slowed down in October as the big car makers and most two-wheeler makers reported a single-digit growth in October. Now, is this because of a higher base last year due to the festive season, or is this a sign of things to come? Yatin is standing by to give us a sense of why this has happened, and is this a long-term trend? Yatin.
Afternoon, Harsha. And if you look at the festive season last time, it happened exactly a year back. So clearly, because of higher base, this time we have seen the growth moderate for most of the auto companies. Of course, despite that high base, companies like Maruti have been able to post a total sales growth of close to 9.5%. As far as Bajaj Auto is concerned, they reported the numbers in the morning. They were also healthy. In fact, we saw double-digit growth coming in as far as the export markets are concerned, and the management does expect that due to the new launches, we could see some traction both in the export market and in the domestic market in the second half. Similarly, if you look at the overall picture for Mahindra and Mahindra, the overall sales were lower for both the autos as well as the tractor segment. Of course, in the tractor segment, the management improved the guidance for the industry sales moving forward by almost 200 basis points, which means that probably in the second half and the full year put together, we could see some better growth on rural demand picking up, as well as better monsoon, which has a ripple effect on the demand. Royal Enfield sales continue to see good growth on the back of healthy order books. 18% growth was seen there. Ashok Leyland, that is one commercial vehicle player which saw marginal growth of only 3%, below the street expectations. But if you look at it from the passenger vehicle side and the two-wheeler side, the numbers have been quite healthy. However, we have not been able to see stronger growth as expected in the commercial vehicle space.
All right, Yatin, thanks so much for that. Let's get on to earnings. We've got Power Grid on our agenda. We've also got Vedanta. Could be interesting numbers from both of them. Jayesh Khilnani and Nikki Mirchandani standing by. Jayesh, let's get to you first. What's the anticipation from Power Grid?
Ira, we are expecting a strong performance from Power Grid, wherein the profit growth is likely to be driven by the regulated equity income that they get. Now, in terms of numbers, we are expecting revenue to grow at about 18% in excess of 7,300 crores. EBITDA is expected to grow 15% at 6,472 crores, and the net profit is likely to grow at 14% at about 2100 crores odd. In terms of the segmental performance, the transmission and consulting business is expected to grow anywhere in the range of 20 to 22%. In terms of the factors that we are watching out for, commissioning will be very important, which is expected to be coming in the range of about 7 to 8,000 crores. And also tomorrow is the press conference which Power Grid is going to host. So we'll be waiting for the management commentary on the capitalization front. The stock has been trading near the day's high and is up about 1.5%, which indicates that the market is likely expecting good numbers from Power Grid.
Jayesh, thank you for that. Vedanta, meanwhile, is expected to post a healthy set of numbers for the second quarter. Profits are expected to jump 79%. However, higher input costs are likely to impact margins, specifically for the aluminium business. Nikki is here to give us to tell us what the market is expecting. Nikki.
We're expecting good set of numbers for Vedanta. The stock has risen as much as 5% today, and yesterday also it gained as much as 4%. So yes, the market is going with high expectation. As you correctly mentioned out, we are expecting a PAT of nearly 79% at 2,242 crore as compared to a figure of nearly 1,252 crore in the base quarter. In the top line, we're expecting a 32% growth there. 21,000 is the number that we're estimating, and this compares with the number of roughly 13,600 in the base quarter. Well, in terms of EBITDA there, a 27% growth YOY is what we're looking at, but then margins are expected to stay muted at 28% as compared to 30% in the base quarter. Just to quickly run you down as to what are the rationale behind the preview that we've made. Well, we are expecting an improvement in volumes coming in because of the solving of few issues that we had in the plants, and also the higher LME prices are expected to aid the top line growth. Now, the pots outside at a Jadguda smelter plant and also ramp up of Talwandi Sabu plant is expected to aid the volume growth of the company. Besides that, good show by Hindustan Zinc, which is also subsidiary to Vedanta, is expected to aid the earning. But then the higher input cost of aluminium business is something that could weigh down on the margins. That's perhaps the reason why we're looking at a muted sort of a growth. The key things that we like to keep an eye out on, A, is the input cost, and also the EBITDA per ton of the aluminium business, which is comparatively a low profitable business out there, and also the cost of production related to this business. Apart from that, we'll also keep an eye out for the EBITDA of power business, given the ramp up of Talwandi Sabu plant, because a fire accident broke out in quarter one, which affected the production of the company. So this time around, we're expecting some sort of volume improvement, given these problems are now resolved for the company.
All right, thanks so much for that, Nikki. Those are some of the earnings that we are watching out for. We are also watching out for IPOs, and I think the frequency with which we talk about IPOs tells you that the primary market is well and kicking. I think we've got one new one almost every day to talk about. This time it's Khadim India. They're a shoemaker. It's a relatively smallish issue, 550 crore, but their standing in the market is not bad. The issue so far is subscribed just about 6% till 1 p.m. Somit is joining us with the details there. Somit, they're second to Bata or thereabouts?
They're second to Bata. Bata is the number one. And so Khadim India is looking to raise close to 543 crore within a price band of 745 to 750. Now at the upper end of the price band, the valuation would be close to 1,350 crore. Now the issue is a combination of offer for sale and a fresh issue. In the offer for sale, the promoter would be selling around 54 crore rupees of share, while Reliance Nippon's arm, that is Reliance Alternative Investment Fund, would be selling share, would be completely exiting from the company and would be gaining close to 5 times its investment and would be selling shares worth 439 crore rupees. Of the fresh issue, that is 50 crore, 40 crore will be used for debt repayment, while the remaining 10 crore for general corporate purpose. Moving on to the business of the company has two segments, that is retail and distribution, and it's an asset-light business model with 80% of its retail stores are franchised. Now the company also has two manufacturing plants in West Bengal and 4 distribution centers across India. Moving on to the company's financials and peer comparison, the company's revenue and net profit grew at a compounded annual growth rate of 10% and 36% over FY13 to FY17. When you see the revenue, it is it grew at a slower rate compared to Relaxo, but net profit grew at a faster rate compared to Relaxo. Comparables of Bata India is not available because they had changed their accounting policy in this period. Now, if you see the EBIT margin of the company, it is muted at 8%, and this is because of their asset-light business model. Now, if you see the return ratios of the company, it stands at around, return on equity stands at around 16.6%, capital at 25%, and return on asset at 7.5%. Now, these ratios are better when compared to Relaxo, but when compared to Bata, but not as good as the numbers that Relaxo had posted in financial year 2017. Now, if you see at the balance sheet of the company, the book value per share is around 107, total debt is 118 crore, which would further go down by 40 crore, while total debt to equity stands currently at 0.6 times. Now, finally coming to the valuations, if you see the share price that is at the upper end, that is 750, the price to earnings is around 44 times, which is cheaper when compared to Relaxo and Bata. If you see the other two valuation metrics, that is price to book and market cap to sales, it is still available at a cheaper valuation compared to Relaxo and Bata. And if you see brokerages, most of the brokerages have a subscribe rating. Only Angel Broking has a neutral rating on this IPO so far, and they have a neutral rating because they think that the current valuations have priced in the future growth of the company. And let's hear what Khadim India's management had to say to us on this.
We are very optimistic about West and North, particularly West, because over the last 1 year we have opened around 6 stores in and around Bombay, and those stores are doing reasonably well. So we are optimistic about West. Other than Mumbai, we already have stores in other parts of Maharashtra as well as Gujarat. So going forward, we will be looking at stores in other regions also. On an average, we do open about 70 stores year on year. That's what we have been doing over the last 2-3 years. We populate South more through our franchisee outlets, and West and North, where there is the visibility is relatively lower. We are a newer player in those regions. We will open our company-owned, company-operated outlets.
All right, that's the management of Khadim, but customers are using UPI more and more as a mode of transaction. That's according to data released by the Reserve Bank of India. The report indicates that transaction volume has more than doubled in October, but the average value of transactions have dropped dramatically. Vishwanath Nair has been tracking the story for us. Vishwanath, take us through some of the highlights. Why and what's the inference?
Well, what we see here, Harsha, and this is the number that NPCI's Twitter handle put out last night, and it's a verified Twitter handle, so we can trust that data. And what they are saying at this point is that in October, UPI transactions rose to about 77 million. This is as compared with, say, September, where the number was about 31 million. So that's more than doubling of the transaction volume. Similarly, if you look at the transaction value that has moved, it has gone from about 5,300 crore to over 7,000 crore. So on an aggregate, if you see as compared to average value per transaction, that has dropped to below 1,000. This is important primarily because in the past, in June specifically, HDFC Bank was the first bank to put out this notice to all of its customers saying that it's going to start charging for UPI transactions. At that time, the NPCI, which is the nodal agency for all UPI transactions, they intervened and they said that don't charge right now because probably the technology is not available everywhere else, and it's probably not being used as much. As the average value comes down, which would mean that more people are using it for daily transactions, only then you will see some kind of charges coming in. So probably now is the time, and we spoke with AP Hota, the former chief at NPCI last night, and he was saying that at some point now the charges should start rolling in. As of now, UPI is completely free.
Okay, so a couple of questions. One, it seems like Google Pays is the reason why you've seen such a sharp jump. But there's a bit of artificiality there, right? Because someone on Twitter mentioned that they were giving incentives to sign on people.
So when they initially launched in September, at that time, Google Pays had said that they would give about a 51 rupee cashback as and when you make transactions. So that was a push factor, but that was only in September. Later, again in October, if you see, the number has increase further. So it's not like there was some kind of slowdown after this cashback offer was rolled back. Some people who we spoke to yesterday were suggesting that it's probably because it was a festival time, so it was like a token gift sort of thing. That was happening more and more. So people were making smaller transactions. But we don't know, unless the November numbers show a similar kind of increase, we can't really say that, you know, it's just the festival season.
And in November, we may see, or November, December, we may see WhatsApp come onto the platform as well.
That's another big entry, because apart from PhonePe and Bheem, who have been dominating the space so far, Google Pay sort of was a challenger. And then after that, now when WhatsApp comes in, obviously it has a much larger user base, so you know, much easier to use it on the phones that way.
Thanks so much for that interesting space, not market related, but interesting nevertheless. All right, let's move on. Let's move on back towards the markets and investment opportunities in the market. Capital good companies had fallen out of favor of late, with most of them complaining about muted demand and idle capacity. But that's exactly what will hold them in good stead in the near future, says Kenneth Andrade, the founder and chief investment officer of Old Bridge Capital. He spoke to Neeraj Shah earlier and said that as you move over a cycle where capacity starts to get utilized more and more, that will be positive for a lot of these companies.
All that I look for as far as the data that comes through is which companies actually have a low capacity utilization and push it forward. And today where we're actually sitting, I mean, I haven't seen these numbers with 2017 balance sheet. It's only gotten better over the last decade. Okay, and going into 2019, I think we'll have a very pristine looking corporate India's balance sheet. You're going towards debt equity, which will be close to its historical low. You've got capacity utilizations at 70%. You got a lot of output coming out still. And I think all of that, if you just quantitatively put it together, at the end it looks very good for end shareholders.
So money to be made in fractured balance sheets which are seeing repair. You would reckon that's the theme?
Reasonably leveraged companies, yes.
Reasonably leveraged companies. Infrastructure would form part of that, or no?
I mean, it's too broader.
Narrow it down for us.
Yes, it's too broad a category to look at. But
so narrow it down for us.
You will have any asset-intensive businesses coming back. I mean, capacity utilization is a function of the assets on the ground. The assets on the ground and demand coming back is basically capacity utilization is going up. Capacity utilization is going up, higher cash flow, which incrementally means lower debt. Okay, and you can put the math together.
Okay, let me ask you a pointed question, so to say. I'm not getting into a stock, but I'm just telling you a conversation that I had, for example, with 2 or 3 managements. One of them was Thermax, and they mentioned, while they have a large international presence as well in their order book, but they mentioned that they are seeing orders coming in from sectors which hitherto had not given orders. Fertilizers, for example, was one pocket that he mentioned about. And he mentioned that it will be a play of my capacity utilizations levels moving up. So would you believe that cap goods could be one pocket that could do that?
Yes.
Very few players.
Capacity utilization is equivalent to higher pricing at the end of the spectrum. Okay, so today we're only talking about higher capacity utilization, but once capacity utilizations hit that 80% mark, and that's when companies start taking pricing, right? So if your fixed costs are in control, which most of these guys have it right now, your operating leverage in some of these businesses are large. Okay, commodities, engineering, infra businesses.
Okay, fair call. So that's a wide gamut as well. 2 pockets which were considered gruesome. Selectively, companies are doing well. We've spoken about one, which is real estate. 2, aviation. Is there merit here?
It's a consolidated market, and capacities will only come in line with what demand is there. So, barring a year or 2 where you will have surplus capacities on the ground, I think that industry is fairly. I mean, it almost looks like it's like an industry which some time back looked like cement.
Oh, interesting. Okay.
Now, so a very consolidated market. Pricing is dictated by very few on the ground.
Yes.
Okay. And the domestic space looks nice.
And while it's difficult to predict the key input cost, but is there a sense that because crude may stay where it is or not really dramatically improve too much, that kind of gives a more predictable earnings cycle to these companies too?
So this will be one of the cycles where aviation will have to test out its ability to price inflationary costs into the market. Right. So it's also a function of demand, and if demand continues to be robust, Okay, I think these guys will be able to pull it through.
Interesting.
This sector will be able to pull it through, yeah.
Okay. And within the broad basket of consumption, I'm kind of clubbing aviation as discretionary spend. Anything on the consumption, be it staples, discretionary or otherwise, that you believe could continue? It's a space that has really run its course, if you will, honestly ask me, but is there more steam left out here?
I think valuations are expensive out there, and growth out there could be a little back-ended because the kind of job creation that's happening in India is not the blue collar, white collar jobs that have been there. It's more very labor intensive jobs, so where the per capita incomes would not be significantly high. I won't see a disproportionate growth in per capita GDP, first to say. So I think that cycle could tend to be a little back-ended, the discretionary spends.
And you can catch that entire interview with Kenneth Andade that's coming up at 4:30 today on Bloomberg Quint. Slip in a short break. On the other side, we discuss oil demand supply situation with Vandana Hariyobanda Insights, markets and fund flows with Jonathan Sheasel of Ashburton Investment, and market valuations and investment avenues with Harsh Rungta. That's coming up on the other side.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
More than just business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines at the half hour. Lackluster trade in the markets with the Nifty attempting to reclaim the 10,450 mark. Mid-caps outperform with half percentage gains.
The US Federal Reserve sticks to its December rate hike even as Donald Trump looks all set to nominate Jerome Powell as the next Fed chair.
And OPEC's output drops by 120,000 barrels a day as Kurdistan tensions weigh on Iraq, sends WTI crude prices above the $54 per barrel.
All right, let's take a closer look at how the markets are faring at this point in time. It's been a bit of a flat session today. Pradeep, of course, is taking a closer look at some of those stocks that have been moving. What's going on, Pradeep?
So just a profit booking after yesterday's fireworks, so to say, at higher levels. This is not surprising, really. But if you look at the top volume stocks, well, still there is more buying than selling. So bulls are not going anywhere. That we can definitely say. But what has happened is there is only one sector which has taken the leadership, that is pharma. And unfortunately, this sector doesn't really have a significant weightage to, take the indices up. Also, if you look at the mid-cap and small-cap space, what has happened is there is significant profit booking in last 1 hour of trade. So that could be the bearish sign in today's market, I would say. But what is the good news on the other hand? At least on the pharma stocks, last that I have spoken to some of the dealer friends, what they tell me is there is still some buying coming in. So orders are actually coming in. When Divi's lab, goes up significantly, and still if you have buying coming in or so in the other pharmaceutical sector stocks, this is really a good news. So there is buying interest. There is also buying interest in PSUs, but here we are not so sure, what kind of money is really coming in. Probably there's more speculation now than, solid buying. This scenario in pharma and, PSU is markedly different. That is what the analysts are really talking about. There's also interest in some of these select IT names like Hexaware, which came out with excellent numbers. So selectively, there is still buying, and there is more buying, being reported in dealing rooms than any significant selling.
All right, Pradeep, thanks so much for that. That's the equity market check. Let's get on to the currency markets as well and see what's happening on oil prices. Oil prices, of course, all important for the Indian markets. Vandana Hari is joining us on the phone line to give us a sense of how things are moving and what could shape the course of oil prices. She's founder at Vanda Insights. Vandana, good afternoon. Thanks for taking our call. Just first word on recent developments in terms of output numbers. Anything surprising there that would change the direction of oil prices?
Good afternoon, Ira. So we saw overnight a bit of a pullback in Brent, especially far more than WTI prices, which appears to have been in reaction to U.S. stocks report by the EIA, which is the official data that comes a day after the industry data. And though EIA reported across the barrel declines in U.S. stocks, and mind you, this is a very important data set that the market focuses in on every week. Though EIA reported across the barrel draw, it was less than what had been reported by the industry body, the API, a day ago, and which had been factored in a day before into the prices. So what happened was crude essentially gave up some of those gains because there were draws in stocks, but not as much as had been expected.
So Vandana, put this in context. Brent has been up 7% since the 23rd of October. And there is a view that these production cuts are likely to be extended. Is that likely to happen? Is that what the market is factoring in?
Right. So we have seen quite a smart rally in Brent prices. It started pretty much around August, and it has picked up pace, especially after the Kurdish referendum on September 25, and once again in last week. Definitely, the OPEC, non-OPEC cuts are underpinning this turn in market sentiment towards a very bullish tone. More to the point, the observation that inventories in the OECD countries are finally starting to decline. I think that was a very important indicator the market was wanting to see. After a while, it just got tired of seeing, that OPEC, non-OPEC compliance is very good, but the market wanted evidence. And it has finally got that evidence in the third quarter of this year. According to the International Energy Agency, stocks dropped, and that was counter-seasonal. So that's something definitely the market took note of, especially distillate inventories, distillate including diesel and heating oil. And heating oil demand will go up in the Northern Hemisphere winter in the coming months. So the market has focused in on those. And of course, the latest addition to that bullish tone has come from the geopolitical risk on account of Iraq, where exports have dropped anywhere between 200 to 300,000 barrels per day. That's not a huge amount, given that there's plenty of capacity within OPEC and non-OPEC that they have reined in. But it's more the fear as to what more could go worse in Iraq and crimp even more of the country's exports.
So if you just keep the demand supply, the near-term situation aside for a moment, would you say that the undertone of the market remains to be bullish, and you're likely to see oil prices head higher from these levels in the next 2 to 3 quarters?
Yeah, so when we talk about oil prices, it's important to keep day-to-day movements are interesting and important, no doubt. But as you mentioned earlier, good to keep in perspective the fact that after so many weeks of being in the high 40s and low 50s, Brent is now 60, and even after the overnight pullback, it's still sitting way above $60 this afternoon. So that is indeed a result of a broader bullish narrative that has taken hold of the market's imagination now, which includes, kind of agreement, shall we say, that OPEC, non-OPEC cuts are working, much slower than had been originally anticipated, but they are draining inventories. U.S. production growth is happening. U.S. production is growing, but it's moderating. So we're just looking at the latest monthly figures from the U.S., and year on year so far this year, U.S. production is up just about 300,000, less than 300,000 barrels per day. So that's a far cry from up to 1 million barrels per day that had been expected at the start of the year. And then there's the geopolitical risk, of course, Iraq, then to some extent, a little bit in the background, Iran as well, but more so Iraq right now. So, yes, to answer your question, I think these factors have now, I think, staying power. And I see Brent supported. I don't see much of an upside from here for Brent, but I definitely see it supported at least in the mid-50s to high 50s. We might see a bit of a correction, but definitely the tone in the market has changed to bullish now.
Vandana Hari, we leave it there. Many thanks, Nick, for joining us on the phone line. That's Vandana Hari talking about oil prices. You have seen a significant increase in oil prices in the last couple of weeks. Brent particularly has moved up about that $61 mark. Yeah.
All right, I think for India, anything between 60 to 65 is comfortable. It's only if you have a sustained rise beyond that, macroeconomically, does it become a problem. Let's get back to global markets and this time central banking. Lots of central banking action. We'll have the Bank of England meeting today. We will later today perhaps get a final word on the Fed chair announcement as well. Let's welcome in Jonathan Shizul, CIO at Ashburton Investments, to discuss all of this and its implication for market sentiment. Jonathan, good afternoon. Thanks so much for taking the time to speak with us. I'm going to start with the BOE, Jonathan. I think everybody's anticipating a rate hike. I think the only question out there would be what would the language suggest about the future course of Bank of England monetary policy? What are your thoughts, sir?
Yeah, look, I mean, clearly the market is, as you rightly say, expecting some sort of action, which will be quite momentous in itself after such a long period of obviously falling and then obviously no rate moves. So, yeah, it's the language around inflation, the language around the upcoming ongoing Brexit negotiations, which will provide that uncertainty, which, you know, clearly, I guess the market will be thinking, is this a one-off, or is this now going to be a series of small rate rises for a short period of time? So, yeah, the language is all important.
What did you make of what you heard from the Fed overnight, and more importantly, the name of Jay Powell doing the rounds of being the next Fed chair, Jonathan?
Yeah, look, if I'm really honest, we don't, we've tried not to get too involved in worrying about who might or might not be the next chair. Clearly, there's a huge amount of rumors swirling around, and it seems to change by the week. But yeah, it seems to be building a bit of momentum now. We're not really too focused on that till we know exactly or have a bit more clarity on who the next Fed governor will be. So, yeah, we don't comment on that particular speculation at the moment.
Okay, let's talk about markets right now. You know, we've seen significant amount of interest coming into the emerging markets over the last couple of months. India particularly has seen, although foreign investment flow has relatively reduced in the last 2 months. How are you feeling about India, both flows and valuations in the Indian markets?
Yeah, so I think clearly, the recapitalization news of a few days back is another step in the right direction, and a very significant one at that. Yes, we do need more information. Yes, there's still other pieces of legislation or action to come. I think from a foreign investor perspective, when we look around the globe, I think it's fairly clear that people still are certainly focused on emerging markets in particular as a group. And emerging markets as a group still, from a valuation perspective, look quite attractive compared to developed markets, and particularly compared to the US. Now, of course, when people actually drill down into the EM space, India still trades relatively expensively. Our view would be, you know, obviously with the flow, as you rightly talk around there, with the heavy domestic flow that we're seeing in India, we wouldn't think that there is a large risk, shall we say, of a derating going to come anytime soon. And obviously with the incremental positives around continuing reform coming through, we think India will just trade expensive for some time. Clearly, we're all waiting for the earnings recovery to kick in. And clearly that's still probably a couple of quarters away. So, Yes, the market's certainly expensive. It has been for some time, and we think it will be for some time as well. So, yeah, I think foreign investors are probably, over the last couple of years, haven't really been that active in India. And, you know, I think potentially that could start to change if there is a genuine belief of the investment cycle coming back and earnings finally kicking in.
Jonathan, so in the scenario that you describe, and that seems like the view a lot of people are taking on India, do you think that the biggest risk, or perhaps the only risk that one can foresee, is probably more global than domestic, unless there is an unforeseen further or continued weakness on the GDP side? Do you think domestically we're sort of steady state from here, and the only risk that could emerge is globally if things start to look nervous for global financial markets for one reason or another?
Absolutely. I think India tradition for some time the major risks have been sitting outside India. Of course, we've got local state elections coming up in the next few months, so there is some element of political risk, but I guess I would agree it's not a huge risk at this stage, and therefore yes, if you do get some sort of geopolitical event globally, or that sparks off a sell-off in US markets and developed markets, there's no doubt that India will take a hit as well. So yes, I would agree with you that the bigger risks today are probably sitting outside of India than inside.
Would you share the same confidence for EM currencies and the rupee perhaps, or would you place your bets on the US dollar?
I think, yeah. So our view, the dollar, has been in a sell-off for a little bit of time. It seems to be trying to recover. I guess the question there is what really is going to happen with US rates, and then it comes back to your point again about the next Fed governor. So we as a house do have quite significant exposures to various emerging market currencies on an unhedged basis. So we actually think there is quite a bit of value sitting in various EM currency plays at the moment.
All right, Jonathan, thanks so much for joining us. Appreciate you taking the time to speak to us about the macro picture and also the India story as it's playing out in the minds of foreign institutional investors.
Let's do a quick check on how the European markets are faring ahead of the crucial Bank of England policy decision today. Bloomberg's Bree Taylor joins us from our studios in London. Bree, all eyes are on Bank of England. What's the expectation? No rate hike?
So, as you just mentioned, the markets just opened. We're about 15 minutes into the trading day here in Europe. We're seeing the Euro Stoxx 50 down slightly, while the FTSE 100 here in the UK is up slightly. We're also watching the pound. As you mentioned, today is the BOE Super Thursday. We're going to get a rate decision, and investors are really expecting the BOE to hike rates for the first time in a decade. And BOE Governor Mark Carney has really laid the groundwork for this hike multiple times, but hasn't delivered. So today, the big question is, will he actually deliver on that rate hike? And we will be watching the pound closely, see how it reacts, as well as gilt. And so we're expecting that decision to come out at 12 p.m. UK time. So in just about a little under 4 hours, and right back to you.
Bree, thanks so much for that. That's the Bank of England rate decision that is expected later today. Well, let's just focus back home. We've seen exuberance in the Indian markets that the country's largest fund manager, Shankaran Naren, is worried. This is the Chief Investment Officer of ICICI Prudential AMC. He told Bloomberg, and I quote, that we've had a long period from 2011 without any big drawdown in stocks. And it's tough to convince mutual fund investors that stocks may actually fall. So the bigger question here is, what should an investor do now? Should they stay in cash, stay away from mutual fund, look at other asset classes, wait for a correction? Or will this mean losing out on an opportunity if stocks head higher from these levels, that is? Let's get in Harsh Rungta, a certified investment planner, onto this conversation. Harsh, thank you so much for joining us. My first question to you is, what does an investor do now? We've seen stock prices increase significantly. There's been significant amount of money coming in through the SIP route into the markets. For a mutual fund investor who's been invested for the last 24, 36 months, what should he be doing now?
So I think the money that you put into equities, and definitely what you put in through a SIP route, is money meant for the long term. In the whole advantage of putting money through the SIP route is that it is able to take care of peaks as well as valleys. So the best thing is to do nothing, I think, because you don't need the money now, you're going to need the money later. Obviously, when stocks are, even if we assume that the stocks are expensive, you're getting less of the stocks when your SIP amount remains the same. And you will get more of the stock if the price, for example, falls. If this makes you nervous, I mean, some investors get nervous when the prices increase as well. The only change that I would suggest, if at all, as I said, first impression, the first recommendation is no change. The only change that I would suggest, if at all, is to look at your asset allocation. If you got into it with planning, you have a certain allocation for equity, and you had assumed a certain return. So you had assumed that at the end of a certain period, your equity will be a certain percentage, your debt would be a certain percentage. If because the prices have risen, you find that equity has outstripped what you wanted it to be, to that much extent you shift it to debt. Otherwise, the answer is do nothing. And this allocation is something you should do whether prices fall or prices increase.
Okay, so let me flip this and ask you another question. So what if somebody wants to enter the market at this point in time? I mean, either through the SIP route or wanting to make a lump sum investment, and when prices are at these levels, what would you say to him?
So again, if you want to enter the equity market, I would not recommend a one-shot entry. Don't try to time the market, right? So which means that enter it through the SIP route. A possible entry could be in something like the dynamic funds, which regulate the percentage of equity and debt based on some kind of a pre-decided formula, which is not dependent on fund manager discretion. The proportion of debt and equity is not dependent on the fund manager discretion. They obviously actively choose the equity and actively choose the debt, but the proportion is decided as per a formula, pre-decided formula. So that you have primarily equity funds like dynamic equity funds. You have what are called the balanced advantage funds, which are extremely popular currently, where on an equilibrium basis, I think the equity would be about 65-70%, but currently a lot of them, the equity proportion is about 44%, 40 to 45%. Then you have the equity savings, the dynamic equity saving products, where again the equity percentage currently would be around 20-25%.
Okay.
All these three categories are treated as equity funds because they have a balancing figure as arbitrage. I think if you want to make a lump sum investment, if at all, I would say spread it over at least 6 to 12 months, and even then, you do it to a dynamic fund or a balanced advantage fund or an equity saving fund, depending on your risk profile.
Okay.
Through a SIP, any time is a good time to invest in tech. So I think as long as it's a long-term SIP, today is as good a time as any.
Okay, so I say one final question. You alluded to arbitrage funds. What about those guys who have stuck with some of those funds that have not performed? Would you suggest now is perhaps the time to switch and perhaps park some money in arbitrage funds? Is that a right strategy?
So you're talking of equity funds that have not performed. So if I'm in a fund that has not performed, then I think how you look at non-performance would really depend. I mean, I would not choose a fund as a non-performer simply because it has, say, not performed in the last 1 year. If you should take a slightly longer-term view of equity funds, maybe at least take 3-year moving averages over 5 years. That is the least that I would take because equity performances take time to play out. And just taking a year's view may not be correct. If you have done that and you want to shift equity, I would shift directly to equity. Why pass it through arbitrage? There is no real advantage of passing it through arbitrage unless you want to reduce the extent of equity, in which case, obviously, you first reduce it from quote unquote non-performing equity funds.
All right, Mr. Lungta, we leave there. Thank you so much, Lee, for joining us with your views. That's the view of a financial planner. He's saying stick to equity funds, keep the faith in mutual funds despite the run-up that the market has seen.
All right. Just before we close off the show, just want to quickly flag off the Bitcoin market. I think people have started tracking it almost as much as they track equities and currencies. That has just taken out $7,000 for the first time. There's no stopping that, no matter what regulators say. That chart and that rally and that, I guess, almost vertical rise continues.
Despite what the big bankers say, despite what the skepticism on the street, that's the story of the Bitcoin for you. So in case you're a trader, take a look at that too. All right, before we go, after nearly a decade, Sony will relaunch its advanced entertainment robo packaged as a puppy called Aibo. The company has decided to resurrect its iconic pet brand in a brand new avatar. Take a look.